Highrise Newsmakers feature brought to you by Cushman and Wakefield BROLL.
Well, look, no two organizations are the same, and certainly even across industries.
Take out your mourning clothes, your top hat, and ask the funeral director to come in and tell you how to organize the end of times for commercial property.
The office needs to work a little bit harder to become attractive these days.
People are probably going to start feeling the pressure, frankly, of working from home, because suddenly you are being prejudiced if you're not in the room, whether it be physically or virtually. And that could be, I suppose, the great South African innovation of driving people back to the office.
We're seeing tenants saying, look, we need to look at a 6-star building because in terms of our commitments to green.
So you have to think outside the box if you're going to be a landlord in this market. Just an office space white box, that's not good enough.
You actually need to be able to reach out and strangle somebody from time to time. Is there money in the market for people to capitalize on acquisitions at this point in the cycle?
Buildings are becoming real mixed-use zones now. I think what's happened is people have worked through this work-from-home scenario. I think they've realized it's not a one-size-fits-all. I think they've realized that productivity in some cases works. In other cases, you need to have people in the office collaborating, working together.
I don't think it's been as bad as that. Seldom as bad as what you think.
A lot of landlords are starting to say, well, maybe power isn't just an input, but it's also an opportunity to expand and diversify their business. So, yes, crisis precipitates opportunity for sure.
Hello everybody and welcome to Highrise Newsmakers. I am Bruce Whitfield and it's brought to you by Cushman and Wakefield BROLL. 3 fabulous panelists for you today. Let's have a look at our marvellous panelists. We've got Mantsi Moiloa, who is the Strategy and Consulting Director at Cushman Wakefield BROLL. Also, Calvin Crick, who's Managing Director, and Sean Berowski. Now, Sean is the Head of Capital Markets. We'll talk to him about funding and financing and other fabulous features coming up in the next couple of minutes here on the show. Mantsi, let's start with you, if we can. Just in terms of the status of property, the pandemic feels like it's in the rearview mirror. The pandemic feels like it's a million miles away. Occasionally, though, we hear Freddie's got sick again, Johnny's got sick again, Sizwe's off work because of COVID once again. It's not gone away, but how is the property sector coping at the moment?
Hi, Bruce. So absolutely, in South Africa, it definitely feels like COVID was just a bad dream. However, overseas, you can still sort of feel the effects of that, and that there's a lot more stricter restrictions that we're coping with there. But certainly, we're seeing a resurgence and a return to the office, which is fantastic news, definitely for both organizations of occupiers, but also for landlords. No doubt they're smiling from ear to ear. Our industrial side of matters is still sort of holding steady and performing quite well. And of course, in retail is recovering quite nicely. So we've seen a new distribution in terms of we call them sort of your logistics and service centers and the delivery of groceries, etc. But there is a positive spin, so there is a bit of recovery happening.
But that was kind of halfway through the pandemic when there was no end in sight. It's good to know that things are opening up once again. Is the opening up universal?
Well, look, no two organizations are the same, and certainly even across industries. So realistically, we're looking at an era of hybrid working. And that has different facets. So it's great that you can collaborate across the world at the same time. So we must be wary about viewing hybrid working in particular as any one thing. The office needs to work a little bit harder to become attractive these days, and that is the challenge to investors as well as management.
I wonder if, Calvin Crick, you are seeing the trend of multi-purpose working, because I think that's been the biggest revolution as far as I can see it.
Absolutely, Bruce. I think what we are seeing is definitely there's a place for all the technology to make our lives easier, travel less, etc. But what we are seeing in terms of the offices, we're seeing a huge flight to quality. People are wanting to be in the best buildings with the right amenities, the stuff that's going to attract the talent. There's a reason to come to the office. As Mantsi said, it's attractive to the employees. What are all of those amenities around, how are you able to collaborate with your friends, your colleagues, etc., build some sort of corporate culture. We found that more and more the corporates are having to put all of that in place so that you can actually drive some sort of organizational culture, as well as the integration, collaboration between staff members. And I think that with the load shedding issue that's come along, people working from home don't all have inverters. Suddenly they're having to come back to the office because I think the employers are saying, well, we're not prepared for you to miss a meeting because sorry, your cell tower is out and you don't have a backup generator. So I think it's a combination.
Exactly right. Exactly right. But Mantsi, that's not what you were talking about earlier. You were talking earlier about making workspaces more attractive. How do you make workspaces more attractive? Is every office space now got to be the Googleplex, or what is the future of that space?
So it needs to all work very seamlessly. You want to be able to support your other amenities and so on. So you don't really feel like you have to leave the building or the precinct. These are all the things that need to be feeling like coming to work is enhancing your life rather than being a sacrifice for it. There's a lot, I think, that landlords as well as occupiers are putting into their spaces when they start planning and designing around that. And I think increasingly that has been viewed as a tenant kind of problem. But investors are realizing that there's a logic, there's a design around there's a logic around designing the common spaces to also provide those outdoor spaces, have your walking meetings, make your working life a pleasant place that also attracts then the tenants that you're very desperately seeking and competing against everybody else for. So you have to think outside the box if you're going to be a landlord in this market. Just an office space white box, that's not good enough.
Sure, Berowski, the head of capital markets. I mean, are you finding that in the capital markets part of the business, that you actually need to be able to reach out and strangle somebody from time to time? Not physically, obviously, that would be violent and bad, but you do need to be able to have honest interactions where somebody goes, sorry, your mic's off, I can't hear you. What? Sorry, oops, I've dropped my earphone, I can't hear you. That immediacy of the space is very powerful, and I missed it. I think we all missed it. Is it back?
I think it is back. There's nothing quite like direct human contact, and the spaces that Mantsi was touching on now enhance that. So buildings that have active frontages and collaborative space and wow foyers and art and pieces like that are very helpful in this day and age. When you're trying to attract tenants to your building, what's the differentiator? So, we obviously, Calvin touched on flight to the best quality space. Often those spaces are the ones where the guys have thought most about these active frontages and amenity space, gyms and on site and restaurants, and buildings are becoming real mixed-use zones now. So you start to see multiple sectors within single buildings, retail on the ground, offices above, maybe even apartments above that. And I think we'll see more and more of that sort of structure happening in our buildings.
I wonder, Calvin, if we look at it, I mean, all of that nice to have stuff, of course, that Mantsi talks about and what we're talking about now in terms of the luxuries and the comforts. But there's a whole bunch of stuff in the background that nobody ever sees. The plumbing and the wiring and all of the really boring, gory stuff that gets power in and waste out. All of that sort of stuff is absolutely critical and is becoming a really, really important part of doing business, because there's no way that you can ever go and see your board and say, well, we had a very unproductive July because we didn't have electricity because the landlord didn't put it in. The pressure on landlords is enormous, I think, to prove up the basis of the amenity scale, if you like.
But prior to the sort of crisis, we were seeing a lot of drive towards getting green star rated buildings. You had your 4, 5, and 6 star green rated buildings. So some of that background work in terms of your 4 star was giving you the sort of bang for your buck, and there was payback in terms of the changes that you made to the infrastructure. But I think what's happening now with more and more multinationals having to sign up to certain ESG targets, carbon footprints, where is their path to net zero? There's a lot of that drive behind that. So not only the amenities, but how efficient is this building? How well does it fare relative to any other position where we're seeing tenants saying, look, we need to look at a 6-star building because in terms of our commitments to green, we have to go into these kind of buildings or we're just not going to make that target.
Sean Berowski, the head of capital markets. When it comes to funding solutions for the future, I wonder, in terms of real estate investment trusts, the REIT sector, just how much pressure there is on the property owners about ensuring that all of these T's are crossed and the I's are dotted in terms of providing those solutions and funding those solutions, because not everybody's got the free cash flow after the pandemic in order to simply to go out and buy solutions.
Absolutely. I think that's something that every tenant requires now. So the listed sector and any private landlord will have to produce the ability for these tenants to actually have seamless energy. Where you fund it, there are multiple variations of those funding models available now. You've seen the rooftop sale or lease, rooftop leasing happen, where solar guys will come and lease a roof from you in a large industrial building or retail building and pay you a monthly income on that. Whether the landlords then provide some income to their tenants is neither here nor there, because I think every model is slightly different. I think on an individual asset like a warehouse, the tenant has a little bit more power to negotiate with the landlord. But where in large retail centres, they just want to have the power available so they can open their businesses. The funding of these assets are critical, and there are various niche players in that sector now. It's almost become a little mini sector, and you're seeing more and more of that happen. I'm sure it's going to adapt and change as the supply becomes a little bit cheaper as well. That might get interesting in the months ahead.
Is there money in the market for people to capitalize on acquisitions at this point in the cycle? And there just seems to be a huge opportunity, a 1980s style lockdown pricing of South African property assets and regional property assets, sort of almost begging to be bought.
It feels that way. It definitely feels as if those are going to make strong conviction purchases now that do very, very well in the years coming. However, it's difficult to fund some of these properties. The funds have found it very difficult to sell their tails, particularly because the PRC have been out of the market for such a long time, and the jockeys that they lent money to buy tails of funds that've been dried up for the last few years. But it's just great to see PRC in the market the other day with the attack transaction, and I think you'll probably see people in property feeling a little bit more bullish now that money's coming back, or it's always been there on the sidelines, but not getting back in any meaningful way. Hopefully that's
Is it the first sort of signal that you've seen, though, when you look at the Sean, that perhaps there may just be a little bit of life in the sector yet? Because for, I think, the last 3 or 4 years, people have felt like, take out your mourning clothes, your top hat, and ask the funeral director to come in and tell you how to organise the end of times for commercial property.
I don't think it's been as bad as that. It's seldom as bad as what you think, but it seems as if we did about 15 billion rands worth of sales last year, and probably slightly more than that. That's not too bad, although it's depressed compared to years gone by. And I think in 2015, it's over 100 billion sold in the sector. So if you've got money now to buy assets, you've got strong conviction on why you're purchasing those assets, then I think you can do pretty well. But it's been hard.
Where are we in the cycle? I mean, the shakeout started 2 years ago. As people started coming back to work, we started seeing some people fail, some people succeed. We started seeing offices get smaller, shops get smaller, factories get smaller, everybody sort of scaling back as much as they could. Have we sort of rattled this cage enough? It's like trying to knock crumbs out of a toaster. Is the toaster clean? Can we now look forward, or is there still lots of nonsense to come out?
Well, I think you need to divide that into the sectors. The office sector definitely still weak, potential to be slightly weaker going forward, although there are signs of life. The good buildings are doing really, really well now. You are seeing areas in Cape Town and Durban with big call centre action coming back to the office. new space being taken up, and that's been incredible to see, because only 12 months ago you're wondering where this next tenant would come from. We were just putting more and more stock on in the market every week. I think Johannesburg's still got a way to go. Pretoria's still got a way to go, but there definitely are transactions happening now. So industrial has done really well. Rents have started to actually increase now for the first time in many years, which obviously is a good sign. And we'll probably see more industrial stock come to the market, more spec building come to the market, and I think yields have held up in that sector.
As we see the interest rate cycle top out, I don't want to call it just yet, but it feels like it's sort of nearing a tipping point. That's surely got to be of assistance.
Well, definitely. If we at the top of the market, then it can only get better. If we at the top of the market and there's a long plateau, then it's still going to be quite tough to trade out of that for the next 12 months. Feels like there might be 1 or 2 more interest rate hikes, and then hopefully, we saw an article from ABSA the other day saying that maybe even September we'll get a decrease in rates. That was incredible to see.
Yes, there are definitely these little signals. I don't know if you're picking it up, Calvin, as well, in terms of just the signals that the market is giving, that if we're not through the worst, we're certainly close to the peak worst, if that's a term.
I agree with that. I think that 12 months ago, we were really worried. I mean, there was a lot of big corporates releasing a lot of space. I think we did some stats. There was probably 50% of all corporates were looking at downsizing by at least 25%, and another 50% of those by 25 to 50%. I think what's happened is people have worked through this work from home scenario. I think they've realized it's not a one size fits all. I think they've realized that productivity in some cases works. In other cases, you need to have people in the office collaborating, working together. And I think that as that has developed, guys have gone, well, actually, we'll move out of some slightly older space, not the nicer stuff. We're going to take a little bit less, but we're going to upgrade what we have. And we're scaling up, moving up the market. So as Sean mentioned, that flight to quality, we've seen some really good buildings have huge take-up where, those deals were non-existent. We've seen a lot of movement, but even in one level below that, your sort of A-grade buildings, smaller pockets of space, we're seeing tenants moving into that. Landlords are letting the space. So despite the load shedding, despite high interest rates, despite COVID and everybody wanting to stay at home, we're seeing office take-up. Exactly when we get to a stage where all of the good stock is gone, that's probably got another couple of years to go, but certainly green shoots and a lot more positive than I think we were probably 12 months ago.
Calvin, I mean, data centers are the new oil. I mean, if data's the new oil, data centers, I don't know, are the lubricant of the oil that is data. They're huge and growing, and the opportunity set in South Africa as far as data centers is concerned, we've seen the big multinationals expand and grow, and for all of the reasons we know of geography and the fact that we are in a good time zone, all of these factors playing into our hands very nicely.
Most certainly, Bruce. We've seen a lot of interest coming from those big data center operators, where all the cloud computing that all the statistics show that we're going to need to have that kind of processing power. We've been dealing with a number of them, but it's not that easy to fulfill that need. Typically they're wanting large tracts of land. They need to be in multiple locations, connectivity, not on a flight path, not in a flood zone, and then they kind of take power for granted, which we don't have necessarily. So they're taking quite a long-term view on this. I think there are initiatives that are being put in place that, these things are not quick to put up. They take a lot of time. They're very, very expensive. So yes, that demand is certainly there. And what we have noticed is that it's also had a kick-on effect in terms of land prices, because everybody now believes that their land is worth a fortune because everybody wants to put up data centers. Not quite the situation, but certainly is changing the market to a certain degree in terms of available land that of that sort of scale that can accommodate these requirements.
So what are the big trends happening in this property sector at the moment? I don't know if we just go through each one of you, Mantsi, and start with you in terms of strategy and consulting. In your division, what do you see as the big emerging trends?
Well, they're certainly making decisions based on technology and actual data sets. So we have a lot of network optimizations that are then happening, where people are saying, but should we be building hospitals, for example, in these particular areas? And if you're not doing that, making those kind of decisions in the context of mega data, then you may end up building hospitals that in 3-4 years' time are ending up in an area that is actually showing attrition with the migration of people to sort of cities, etc. So we want to be futuristic and also a lot more responsive and agile around those kind of portfolio optimizations, but also the rationalization of expenditure, both from an operating cost perspective, but also from a capital expenditure perspective.
What about you, Calvin Crick, from a transaction services perspective? What do you see the big trends as doing?
Big trends are still really that drive towards quality amenities, getting the right space, designing the right kind of office space, if you like, in that market. Making sure that all the right amenities are in place and the right kinds of spaces for people to do their work a lot better when they're in the office. And then the other big trend we're seeing is the big push for ESG. I think, the sustainability is playing huge. I think we've seen it in London. The guys are starting to put, in terms of your energy performance ratings on buildings, you won't be able to let a building if it doesn't hit a C rating by 2027. And I think, we've seen it being rolled out in South Africa that you need to show your energy ratings of the buildings, otherwise the landlords will be subject to fines. I think we're going down that same path. So going back to the question about whether we need to spend the capital, I think they're going to have to do that, or they're going to end up with an asset that is, is not usable or not lettable. And tenants are certainly driving it. Corporates are driving it. They've signed up for all these agreements in terms of what they're going to hit, and the energy that you're using in your offices is a big component of that. And that's going to have to be driven very hard, I think, in the next couple of years.
Will we spend the capital? Will we have the capital to spend, I suppose? And Sean Berowski, from your perspective, yes, the capital is always available. The question is, will we be able to afford it, I suppose? What are the big trends from your perspective?
I think one of the biggest trends in the last few years has been the compliance aspect of buying property. So certainly landlords that are disposing of property have to sell a compliant building rather than, we'll just take this building because the income is X. So transactions taking a little bit longer, but that also actually facilitates a better environment in terms of the real estate sector. So buying a property, you'd want to make sure that you're not passing anything down to your tenant. Everything's compliant. Occupation certificates are in place, water, plumbing, etc., electrical. So there's a big cost factor in that. In industrial buildings particularly, you're seeing fire compliance being a major factor. Insurance companies stepping in there, creating that environment, making sure that everybody is kept in tow and these buildings are fit for purpose, which is a healthy environment to be in. You actually want to buy properties that tick all those boxes. So that's certainly something that we've seen happen over the last few years, but it's sped up now. It feels as if it's a must-have rather than nice to have.
Mantsi, final word from you, just in terms of, if you are a landlord and you do have lots of lettable space, it's going to cost you money to let the space. You're going to have to make it, peak amenities or something along those lines, to have amenity-rich environments, there's your term, to ensure that those environments are as glorious as they can be, to ensure that you are picked as the landlord for the next 5 years.
The usual principles will always still apply. So you're going to have to put out some capex on that, but you're going to want to do that against a measure of reasonable return expectation. So as much as you then are competing against that, there are obviously heavy dependencies on how the economy does in general. And a big factor in that is around the reliability of power. So you have a lot of businesses that have then closed in the recent kind of years, just because of the fluctuations in power and the squeeze also from a landlord perspective on diminishing cost to income ratio. So as much as you have that opportunity, there is still an element of risk that is attached to that. But again, I would say, you might then start seeing a lot of landlords starting to say, well, maybe power isn't just an input, but it's also an opportunity to expand and diversify their business. So yes, crisis precipitates opportunity for sure.
Mantsi, thank you very, very much indeed. And thank you to our panelists for contributing today. Mantsi Moiloa, who is the Head of Strategy and Consulting. We've also got Crick, the Managing Director of the Transaction Services Division, and Sean Berowski from Capital Markets. Thank you for your expert analysis and contribution here on Highrise Newsmakers. I'm Bruce Whitfield. Thank you very much for watching. Till next time, bye-bye.